Price to rent ratio, understanding the key metric for real estate investment. The price to rent ratio is a crucial metric for real estate investors to understand the true value of a property and make informed investment decisions. This comprehensive guide will explore the ins and outs of the price to rent ratio, including how to calculate it, interpret the results, and use it to identify lucrative investment opportunities. What is the price to rent ratio? The price to rent ratio is a simple calculation that compares a property's market price to its annual rental income. It's calculated by dividing the property's market value by the annual rental income. This ratio provides a quick way to gauge whether a property is overpriced, underpriced, or fairly valued compared to the rent it can command. Calculating the price to rent ratio. Step 1. Determine the property's market value. This can be based on recent sales of comparable properties in the area. Step 2. Estimate the property's annual rental income. Consider factors like location, size, amenities, and local market rents. Step 3. Divide the property's market value by the annual rental income to calculate the price to rent ratio. Interpreting the price to rent ratio. Low ratio, under 15. This indicates the property is undervalued and could be a good investment opportunity. Moderate ratio, 15 to 20, suggests the property is fairly valued and may provide a reasonable return on investment. High ratio, over 20, signals the property is overvalued and may not generate a satisfactory return. Factors influencing the price to rent ratio. Location. Properties in desirable neighborhoods with strong rental demand tend to have higher price to rent ratios. Property type. Multifamily properties often have lower price to rent ratios compared to single-family homes. Market conditions. In hot real estate markets, price to rent ratios tend to be higher due to increased buyer competition. High versus low price to rent ratio markets. High ratio markets, typically found in major metropolitan areas with strong job markets and limited housing supply, leading to higher property values and rents. Low ratio markets. This is often seen in smaller cities and rural areas where property values are lower than rental rates, offering better investment opportunities. Analyzing price to rent ratio trends. Observe ratios. Monitor price to rent ratios in your target markets to identify trends and detect potential bubbles or undervalued properties. Analyze changes. Understanding the factors driving changes in the price to rent ratio can help you make more informed investment decisions. Adjust strategy. Use the price to rent ratio to guide your investment strategy, focusing on markets and properties that align with your investment goals. Using the price to rent ratio for investment decisions. Identify undervalued properties. A low price to rent ratio can indicate that a property is undervalued, offering the potential for higher returns through appreciation or rental income. Avoid overpriced markets. High price to rent ratios can signal that a market is overheated, leading to increased risk and reduced investment returns. Diversify investments. Analyzing price to rent ratios across different markets and property types can help you build a diversified real estate portfolio with balanced risk and return potential.